Will the dollar milkshake theory send us into a global depression and be the catalyst to ignite World War III? Okay, if you guys have been living under a rock and you haven't heard of the dollar milkshake thesis, you sure have felt the effects that this deliciously named dessert has had on global financial markets all around the world, okay? The real estate markets are absolutely cratering. Stocks and bonds just had their worst yearly performance in over 2 centuries. And of course, Bitcoin and crypto have been absolutely decimated. And all of this carnage in the financial markets is directly a result of the dollar milkshake thesis, okay? So we're going to be explaining why the US dollar is absolutely decimating some of the largest and quote-unquote safest and not volatile currencies around the world, which have all just lost over 20% of purchasing power when measured against the dollar in the past 12 months alone. Of course, I'm talking about the euro, the Japanese yen, and the British pound, which is at a 37-year low when measured against the dollar. So we're going to obviously be breaking down what the dollar milkshake theory is. We're going to be talking about why the hot war in Russia and Ukraine could be related to the currency wars that I believe we're living under today in the 2020s. And of course, we're going to be talking about how Bitcoin fits into this very complicated global geopolitical world, because a lot of people say to me, hey Luke, if we do head into a global currency crisis and a global depression, isn't that bad for Bitcoin because it's just a risk-on asset that's a higher beta version of tech stocks? Well, the answer to that question may surprise you. So if any of that sounds mildly interesting, I really hope you enjoyed today's video, because I'm going to try and break down all of those very complicated topics in an easy to understand way. So without further ado, let's get straight into it. Welcome back to the Fix the Money, Fix the World YouTube channel. If you are new here, my name is Luke and I make videos on macroeconomics, geopolitics, business, investing, finance, and of course, how Bitcoin relates to all of those topics. So if any of that sounds mildly interesting, feel free to subscribe to the channel because I make videos on those topics on a regular basis. So without wasting any more time, let's get straight on into the dollar milkshake theory. So what is the dollar milkshake theory and why should you guys all care about it, okay? The theory proposed by Brent Johnson, all it says is there's too much debt in the world. That's it, okay? That's all Brent's talking about. Complicated name for the theory, but it's based on very simple principles. He says the world just simply has too much leverage, too much debt, and every single time a global sovereign nation, a government, a bank, or even an individual has too much debt and too much leverage, you have to go through a phase of deleveraging, okay? It's a reversion back to the mean. But the very interesting thing about the dollar milkshake thesis is Brent says every single country around the world has too much debt. And the next recession that we're about to go into, this recession is going to turn into a global sovereign debt crisis, which is then going to morph into a global sovereign currency crisis, which is going to least affect the United States dollar. And it's actually going to leave the United States dollar being the last fiat currency to hyperinflate in what Brent believes is going to be a wave of sovereign currency collapses that's going to unfold in the space of only a year or two. And I actually expect the next handful of years will be the most consequential years in financial markets history. I believe we're about to watch the largest wealth transfer in human history and the largest monetary system transfer in human history. And now those are some pretty big claims. So before we start talking about what's so special with the United States dollar, I want to back those claims up with some data. Okay, so what we're living through is nothing new. Okay, we've watched 52 governments go bankrupt and default on their debt since the year 1800. This report I'm going to slap up on screen right now was done by Hirschman Capital in 2020, and they just looked at governments all across the world since the year 1800, so the past 220 odd years of data. And they found that out of the 52 countries that have reached debt to GDP levels of bigger than 130%, 51 of those countries defaulted on their debt within 15 years. So 130% is absolutely the Rubicon, okay? Once a government gets 130% debt to GDP levels, there's no coming back from it. And what's really concerning about the globe today is there's over 15 countries with debt to GDP levels above this 130% debt to GDP Rubicon. This chart I'm going to throw up on screen comes from a James Lavish newsletter. I just had James on the podcast, so keep your eye out for that. But James shows that the sovereign balance sheets of the 7 largest countries around the world, the G7 countries, if you take an average of their debt to GDP levels, their average is around that 130% debt to GDP ratio. Okay, so all around the world, the biggest and the safest currencies are at that end game where governments have to default on their debt. And when you deleverage a balance sheet or when you default on debt, comes in one or two ways. Okay, so you can either default on that debt in a deflationary deleveraging or an inflationary deleveraging. So a deflationary deleveraging, the government step back and just say, hey, look, boys, we're going to let this malinvested debt liquidate. We're not going to print any more money to bail out the banks and bail out the misallocated capital. We're going to let the markets fall to where they should be valued. And a good example of that is like the 1930s in the Great Depression, where you saw the stock market crash 95% as a lot of private sector debt was devalued. Now, that's not very popular amongst the populace. So that's why governments typically choose to default on their debt through an inflationary deleveraging. And Hirschman Capital showed that the large majority of those 51 countries that have defaulted on their debt in the past 220 years typically chose the inflationary deleveraging path, okay? Because once you have interest rates at zero, you can no longer lower interest rates to encourage more and more people to go out there and get onto the debt Ponzi scheme, okay? So that is the thing about these debt bubbles, okay? They only grow and continue to inflate so long as more and more people come onto the debt Ponzi scheme. And by lowering interest rates in response to every little recession, it encourages more and more people to go further and further out on the risk curve and take on more and more debt. So this chart shows that over the past 80 years, you can see every single time we've had a little recession and some of that bad misallocated capital and debt tries to liquidate itself, the central banks have stepped in and said, guess what? We're going to lower interest rates and we're going to encourage more and more people to go back into debt and inflate this bubble up again. So this is the biggest thing that most analysts miss in the global financial system, I suppose. They think the recession we're going into right now is just the same as any other recession, like the 2008 GFC or the 2000 tech bubble crash or the 1987 Black Monday stock market crash. These analysts are missing the big picture. They're not zooming out and saying, hang on a minute, interest rates are at zero. The next slowdown or the next recession, it's not going to be another garden variety recession. What we're going to see is a global sovereign debt bubble collapse, okay? Because as interest rates are at zero, what's going to happen is the only response that central bankers have to this deflation and this capital liquidating itself is to print money out of thin air and try to bail out the banks and deleverage the balance sheet that way. And we're already seeing the early signs of this happening all around the world. So in response to 2020, we saw the largest increase in the central bank's balance sheet collectively in human history. So central banks all around the world printed over $10 trillion in liquidity out of thin air to bail out their banking system and to deleverage their balance sheet, okay? If you just create 30 to 40% extra money in the money supply overnight out of thin air, all of a sudden is that increases the amount of money in the money supply. Meanwhile, the debt stays the same. So you're kind of deleveraging your balance sheet. That debt to GDP ratio is kind of being decreased through monetary debasement, okay? And this is something that we've seen 51 times in human history. Governments always default on their debt through debasing the money, which steals your purchasing power, and on a lot of the times, it ends in hyperinflation. But what's different about this global sovereign debt bubble collapse is we've never seen one of these countries default on their debt in a globally interconnected financial system, okay? We are living in a global financial system today that has never been more globally interconnected than it is today. So the ramifications of this deleveraging is going to be felt by every single country all around the world. And if I've lost you on any of this explanation of the dollar milkshake theory, let's now start talking about what's so special about the United States and why they're going to be least affected. Okay, so this chart that I'm going to slap up on screen right now, it's a good illustration of the dollar milkshake thesis unfolding itself right now today. So the US dollar has actually strengthened significantly over the past 12 months. It's actually like the best performing asset, the US dollar. Okay, you can kind of see the US dollar has gone on a rally, and what this chart is measuring is the strength of other currencies all around the world compared to the US dollar. So you can see the largest and quote unquote safest currencies around the world are being decimated against the dollar. So the British pound's down over 20% in the past 12 months, and it's at a 37-year low measured against the dollar. The euro, same situation, down 20% and at a 25-year low measured against the dollar. And the Japanese yen, they're at a 25-year low measured against the dollar and down 23% in the past 12 months alone. And this is a very, very concerning sign. So what's so special about the United States, okay? Well, they are the global reserve currency holder. They have held the global reserve currency for the past 80 or 90 years after taking that off the Great British Empire. And all that means to be a global reserve currency is a lot of the globe, the world, holds US dollars in their treasury reserves, okay? The United States dollar makes up something like 70% of global trade. So if you're someone in Egypt and you're trying to buy oil off, say, Saudi Arabia, they're not using their local currencies. They're using the United States dollar, okay? Now that is the exorbitant privilege for the United States. The rest of the world has to use the United States dollar for global international trade. And because the United States dollar is the global reserve currency, lots of countries around the world have enormous amounts of US dollar denominated debt. Okay, now this is the very key point of the thesis. You could be a Turkish company, and instead of having Turkish denominated debt that's denominated in Turkish lira, you have US dollar denominated debt. Okay, same thing. You could be in Argentina, and you don't have Argentinian peso debt. You have US dollar denominated debt. Okay, so this is the very core part of the thesis to understand. Okay, because when the next recession happens, what happens in times of recession? People get scared. They sell their assets. They sell their Bitcoin. They sell their stocks. They sell their bonds, and they run to the most risk-off liquid asset around the world. And today, that is still the United States dollar. So that's why this chart here is very important to understand. Every single time we've had a recession over the past 50 years, you can see that the strength of the US dollar has increased, okay? This is the chart of the Dixie. It's just measuring the strength of the US dollar against other currencies around the world. It's measured against a basket of currencies, such as the euro, the Canadian dollar, the Swedish krona, whatever they call it. And you guys can see that every single time we've entered a recession, the US dollar has gotten stronger. So what happens to all of these countries around the world that have US dollar denominated debt, and the Dixie or the US dollar gets stronger measured against their local fiat currency? What happens is they need dollars, okay? So what they're going to do is they go out to the global forex market and they print their local currency, they devalue their local currency, they increase the money supply, and they go to the global forex market and they buy US dollars, okay? So what this does is it creates an ever-growing demand for US dollars, and it's kind of like a feedback loop, okay? The stronger the US dollar gets, the faster these other emerging countries around the world have to print their local currency. And this is where the milkshake part of the dollar milkshake theory comes into it, because Brent says that central banks around the world are creating all of this liquidity, all of this new money in order to devalue their local currency, in order to go out there and source US dollars to pay down their enormous US dollar debt. So Brent calls this ever-growing amount of liquidity the milk in the milkshake. And he says that once we get into this sovereign debt crisis, what's going to happen is people all around the world are going to be looking at their local central bank printing money and saying, oh shit, I don't really want to hold my local currency. I need to get out of Turkish lira or Argentinian pesos or Australian dollars, and I need to put my money somewhere where it's not being devalued. And Brent says that the United States dollar is going to act as the straw that sucks up all of the global liquidity as capital flees these emerging market currencies and countries and flows to where it is treated best. And as much as I hate to say it, and as much as the gold bugs and the Bitcoiners are going to hate me to say this, but that is still the United States dollar, okay? But that doesn't mean that Bitcoin and gold are not going to play a part in this dollar milkshake theory unwinding. I have recently written a couple articles titled The Bitcoin Milkshake Thesis, because the Bitcoin milkshake theory is going to ride on top of the dollar milkshake theory, and it's going to be a very interesting dynamic to play out. So before we wrap this video up and start talking about how Bitcoin fits into all of this, I want to quickly hit today's show sponsors, because this week we saw a pretty big event go down in the cryptocurrency space. The second largest exchange in the world, FTX, a $35 billion exchange, just went bankrupt. Okay, so I really wanted to tell you guys about Amber. Amber is a Bitcoin only exchange, and they sponsor this podcast and YouTube channel. And we just rolled out to 62 countries. Okay, so if you guys hit on the link in the description down below, Amber is giving you $10 of free Bitcoin to celebrate their rollout all around the world. I highly recommend you use Amber. They're a great Bitcoin only company. They have some phenomenal articles and blogs on there. I've written a few scratchy ones on there myself, so definitely check out Amber at the link below in today's video. But guys, it doesn't matter whether you're using a safer Bitcoin only exchange like Amber to buy your Bitcoin, or whether you're using a shitcoin casino like Binance and FTX to buy your Bitcoin. If you don't hold your own keys, you don't own your own Bitcoin. That's the first rule of Bitcoin. Not your keys, not your coin, okay? That's the revolution that Bitcoin was designed to create. It's giving 8 billion people on planet Earth the same access to holding their own Bitcoin, with holding their own money without having to trust an intermediary or a bank, okay? If you have Bitcoin on an exchange, it's like holding it on a bank. So that's why I recommend you definitely check out today's other show sponsor, who is the Bitbox O2. They create a Bitcoin only hardware wallet. I've got the puppy on me right now, right here. This is the cheapest and the easiest hardware wallet I've used. I have used all the hardware wallets on the market, guys. This is the easiest to use, and obviously today you guys can get 5% off one of these Bitcoin only hardware wallets if you use the link in the description of today's video. Promo code is Bitcoin Made Simple. Very easy to remember. No spaces. Bitcoin Made Simple. Highly recommend you get one of these, the cheapest and the easiest hardware wallet on the market. And of course, let's shout out today's final show sponsor. That is Hodling Apparel. Hodling Apparel makes some of the best Bitcoin and freedom oriented clothing in the Bitcoin space. I highly recommend you go and check them out and grab one of my personal favorites, which is the Ungovernable t-shirt. Okay, Hodling Apparel giving you guys 20% discount on any apparel that you buy over on their store. They've got hats, sweaters, hoodies, t-shirts, you name it, they've got it. So I highly recommend you go and check them out. Links to all of the show sponsors will be in the description of today's video. I highly recommend you check them out. I only support Bitcoin only companies and products that I use myself. So without further ado, let's wrap up this video. So in wrapping this video up, I believe the next 2 to 3 years are going to be the most volatile years in financial market history. I believe that by the year 2030, instead of there being 180 fiat currencies around the world, I think you're going to be left with less than 5, okay? And that's pretty conservative. I believe the only currencies left are going to be the Bitcoin and the US dollar, okay? And that is going to create the Bitcoin milkshake thesis, okay? And it's going to be fascinating to watch. Something else that's going to be fascinating to watch is what happens with these BRICS countries, okay? We did a video that I'll flash up on screen just a couple of months ago when the BRICS countries came out and announced they're creating a new global reserve currency, and I speculated that they may be backing that by gold. I highly recommend you check that video out, because I'm going to make a follow-up to that video this week, because the BRICS nations have come out this week and said, guess what? We have more countries that want to join our alliance, and today, more than half of the world's global GDP is actually centered in these countries that want to escape the petrodollar system, which is controlled by the United States. So this will get into another video that we do later in this week, where we start talking about the geopolitics of the dollar milkshake theory, and we explore the possibility that maybe the United States is weaponizing interest rates, because they are aggressively raising interest rates with the federal funds now at over 4%, and the other central banks around the world, such as the RBA, the European Union, the Bank of Japan, and obviously the Bank of England, all of those central banks have stopped raising interest rates, and we've seen what's happened to their currencies. Capital has left their local currencies and it's gone to the United States, where they can get higher interest rates and they're not losing 20 to 25% of their value a year. So we're going to be exploring the possibility of why the United States may be weaponizing interest rates and exacerbating this dollar milkshake theory we're watching play out. This is a very interesting rabbit hole, but we're going to explore this one in another video. I really hope you enjoyed this video. If you got any value from it, feel free to subscribe to the channel and like the video. All of those cringy things that you do on YouTube does help put this video in the eyes of more people, and that's obviously my goal: educate as many people about money and finance as possible. Obviously a little bit of a PSA as well: if you don't like the video version of these videos, you can read them. I've written a number of articles on these topics that these videos today are based on. So obviously I highly recommend you go check out Amber. I've written 2 newsletters on the dollar milkshake theory and the Bitcoin milkshake theory, so I've got one of them on screen here today. I'll put a link to that blog in the show notes down below. I'll also put a link to another newsletter that I wrote with Coinbeast, which is another Bitcoin only company that I work for, where I also explored the dollar milkshake theory. Highly recommend you check that out. And of course I've got my own newsletter as well, so if you head on over to my profile on Twitter, you will see that it is the first thing that is actually pinned on my profile on Twitter. So I also talk about these very similar topics over in my newsletter. Highly recommend you check that out if you want to. But without further ado, that's all I got for you guys today. I really hope you enjoyed this one. I'm going to slap 2 videos up on screen right now that are on related topics that I think you might like if you enjoyed this one. I mean, I suppose you stayed to the end of it, so I hope you enjoyed this one. And without further ado, I'll catch you guys in the next video.